Okay, next piece of work we have is we're going to look at the rules of debit and credit, right? Now, those words mean things, and a lot of times people in the world use them and they think they know what they mean, and they're almost right, they're kind of close to right. And so the very first thing I want you to do before we go into this rules of debit and credit is forget most of what you think you know about this, right? Because we're going to put it all in context now, right? Depending on your experience and what you've done in the world, you're going to bring different meanings to these from your history. Let that go, right? We are going to start fresh, right? So rules of debit and credit, like everything else in accounting, starts with our fundamental accounting equation, right? Our fundamental accounting equation. Now what I'm going to do is I'm going to T-account every one of these classifications, right? And remember from T-accounts that what? Debits are on the left, credits are on the right. No matter where we are, debits on the left, credits on the right. It's good to get that stuck in your head. So we have these T accounts, right? Now this is a really logical thing. This is really intuitive if you can kind of wrap your head around it. It's the same system. They invented it, and I mean it was first documented in the 1590s, I think. Some little Italian monk came up with this system, and it's really the basis for all financial reporting today. So this is how it works. Here's the rule. A, assets, right? You just have to memorize this one. You just have to know it, right? What you have to know is that assets increase on the debit side, decrease on the credit side, right? So that means if I'm going to increase an asset account, I'm going to debit that account. If I want to decrease an asset account, I'm going to credit that account, right? Assets are what we call a normal debit balance account, meaning that we increase them on a debit, and the kind of balance I would expect to see is a debit balance, right? Remember when we put it in balance T accounts, we would expect assets to have a debit balance, right? That's the normal balance. Can it have the other balance? Yes, of course it can. But normally we would expect to see assets have a debit balance. Now, what you notice, next thing we run into, right, this little equal sign. So that tells us something, right? So as I move to the right, I move across this thing and I come to this equal sign, we mirror image or reverse everything, right? So all I do is take this and do the opposite thing. So as I come across the equal sign, that means liabilities are increased with a credit, decreased with a debit. And the normal balance, the balance I would expect to see in a liability account, would be a credit balance. Same with owner's equity, right? So that's where we are so far. Assets equals liabilities plus owner's equity. Assets, we know, normal debit balance. As we come across the equal sign, we just flip everything over, right? We just mirror image it. So these are credit balance accounts, right? And this would be a debit balance account, right? Plus side says how I increase, minus side says how I decrease, right? So that's where we are so far, but we're not quite done yet, right? First of all, we know owner's equity. We talked about 4 things that affect owner's equity, right? Revenue, expenses, investment, and withdrawals. We're not going to worry about investments, but we know we have those other ones to deal with, right? So when I earn revenue, what happens to my owner's equity? Well, it goes up, right? So over on the plus side, I'm going to come down here and I'm going to pencil another T account, and I'm going to label this one revenue, debit, credit. Now, if this increases owner's equity, we can expect it to behave the same as owner's equity, meaning revenue, I increase with the credit and decrease with the debit, right? So this is the nature of a revenue account, right? Okay, the other side of revenue is what? Expenses, right? Expenses. We learned that from looking at our financial statements, right? We know expenses do what to my owner's equity? They decrease owner's equity, right? So on the decrease side down here, I come over and I build another T account for expenses. Debits on the left, credits on the right. If this increases equity and it's a credit balance, this one decreases equity, we can assume it's going to be what? The opposite balance, right? It's going to be the opposite balance. So that means that I increase an expense with a debit and I decrease an expense with a credit, right? So that's where we are so far. Those are our 5 kinds of accounts that we have to deal with, right? So now everything we do is going to deal with what? An asset, a liability account, an owner's equity account, a revenue account, or an expense account. And we now know how to make increases and decreases in each of those accounts based on this little device that talks about the rules of debit and credit, right? When we have a business, we build a chart of accounts or a list of our accounts, right? So we have to have an order that we put them in. So if we talk about account number order, the way it works, if I'm listing them in order, assets are going to be first, liabilities will be second, owner's equity will be third, revenue will be fourth, expenses will be fifth. Look, it just makes that little U shape around there. Okay. Now, one more thing we have to deal with. We also have what? Withdrawals, right? Withdrawals. Debits on the left, credits on the right. Now, if I want to know what kind of an account is, the answer is going to be it's an owner's equity account, right? But remember, withdrawals do what to owner's equity? They make it go down, right? Withdrawals make owner's equity go down. So withdrawals are going to behave how? With a normal debit balance. I'm going to increase them on the debit side. So what we have here is withdrawals is an owner's equity account, but it's the opposite of owner's equity, right? It's a reduction in equity. So the term that we use is contra equity, right? So the kind of account that withdrawals is a contra equity account because it's what? The opposite of equity, right? So there we are so far. One more little rule that we have to deal with, right? Every transaction, everything that we do, we still have the same equal sign to deal with, right? So everything that we do, we have to make sure that debits equal credits, right? Debits and credits have to equal with every transaction that we do. Okay. What you're looking at here, this little diagram is what's going to carry you through the course. At some point, I'm going to ask you, what's the normal balance of owner's equity? And what are you going to tell me? Credit balance, meaning what? I increase owner's equity with the credit, decrease with the debit. What's the normal balance of cash? Well, cash is an asset, meaning I expect to see a debit balance. I would increase it with a debit and decrease it with a credit. Okay? So that's the official rules. Now, the one thing that befuddles everybody, right, is we have in our pockets these things called debit cards, right? And you take your debit card and you swipe it in some machine and your account goes down, right? So you're thinking in your head, debits make things go down. And you go to the bank and the bank says, we're going to credit your account. And what happens? Your account goes up, right? Well, it's important to remember that the bank is not you. The bank is looking at this from their perspective, right? So you put money in the bank, that's an asset to you, right? That's something that you own. But when you put money in the bank, you want to be able to do what? Get that money out. So your checking account, the money in your account at the bank, is a liability to the bank, right? So in the bank, when you swipe your debit card, you're doing what? You're dealing in the bank side of the transaction, so the debit makes it do what? Go down, right? So that's why your debit card is labeled your debit card, right? And when the bank says, we're going to credit your account, right? We're going to credit your account does what? It goes up. Why? Because the bank looks at that account of yours as a liability, right? So that's why banks use those terms like they do. They're not doing it wrong. They're just doing it from their perspective. We are looking at it from the perspective of the business or the individual. So that's an important piece of the puzzle. Again, I can't tell you how important it is to get a little understanding of this, right? The next thing we're going to do, we're going to put these rules to work, and we're going to actually look how we're going to record transactions. So we'll make some more sense of this as we continue to add more steps to the process, right? So there we go.